Okay friends, let us start with today's session. So let me just give you an overview of today's session. So this session is basically for batch 2 and SAP FICO module. So in this session we will try to understand the approach that a FICO consultant should follow or generally follows in any real-time project. We will also try to understand what are the activities that will be performed and what attributes a consultant should hold in order to become a good consultant. In real-time project, I would say that it is very difficult to deal with client if we lack knowledge about the subject matter. So as a FICO consultant, it is must that we understand accounting and the ERP. ERP nothing but the SAP functionalities. Only if we are aware how SAP functions, then we can map the client requirements into the ERP. Otherwise, it is very difficult to understand the client requirement and map those into the ERP. With this, we will try to understand various different terminologies that we use in SAP. Okay, so let us begin with the session for today. So in today's session, we will try to understand taking one of the group companies into consideration. So the group company that I have taken is RAM group of companies. So under this RAM group of companies, we have 5 entities, means individual companies operating. So all these 5 individual companies, individual entities, legal entities have their own registrations with the Companies Act, since those are operating in India. If those are operating in any other country, then they will have to follow the Companies Act of those particular countries and must be registered under those acts. So we have understood that we are going to understand the requirements for RAM group of companies, which is having 5 individual companies, and all those companies are registered in India under the Companies Act in India. Okay. Now, RAM group of companies is called as company in SAP. Okay, and all the 5 individual companies is called company code in SAP. I hope these two terminologies is clear from the SAP perspective and general finance perspective. Company, company codes, group of company and individual companies. Coming to reporting part. So when the company operates, it has to file its balance sheet and profit and loss statements. In short, the financial statements with the government, so that the government keeps track of the companies and prevent any fraudulent activities by the companies operating in any particular country. So if the reports is prepared to submit it to external parties, for example government, those are called external reports. And within FICO, FI means financial accounting is the one that deals with external reporting. Similarly, some of the reports might be required by the company's management internally to take strategic decisions. So whichever reports are prepared for internal use within the company for different level of managements, that is called internal reporting. And within FICO, the CO module, that is controlling module, is the one which deals with internal reporting. So as we have understood, external report is for external parties and internal reports is for internal parties like management. So when the management wants to prepare any report, it is completely their discretion of the rule that they want to apply to prepare those reports. But if the reports are prepared for external parties, for example government, those reports must be prepared keeping in mind the accounting standards that the accounting body of any country releases. So we understood that internal reports are not based on any accounting rules, but external reports must be based on standard rules, so that the report of one company is comparable with the report of other company. I hope you get what I mean. Okay. Now, if I talk further about internal reporting, internal report varies between clients. When I say this, I will link it to the original statement when I said there is no standard rule for creating internal reports. So the management of different companies may apply different rules to prepare the reports that they need to take strategic decisions. So that is why I say they vary between the clients. Now internal reports may be with COPA or without COPA. When I say with COPA, that is called with profitability analysis or margin analysis being active in our SAP. And when I say without COPA, that means profitability analysis is not active in the SAP. Now we will understand the term COPA. COPA means a module within controlling. It is a sub module within controlling which tells the profitability achieved by any company based on different market segments. It can inform or it can report the profit that is generated by a company per market segment, per product, per geographical area, per customer, and different other dimensions. Those different dimensions under which the profit of a company can be analyzed is called as characteristics. Okay. I hope now you understand the meaning of COPA, the meaning of characteristics. Now, another term is operating concern and controlling area. Whenever the COPA module is implemented in a company, then operating concern is the top node. And if COPA module is not implemented in a company, then the controlling area becomes the top node. Now what is operating concern? Operating concern is nothing but an org element for internal reporting which deals with analyzing the profit of a company. Okay. Controlling area is another organization unit within controlling module under which all the controlling transactions, all the controlling activities are recorded. Now we have understood that if COPA is implemented in SAP for a client, then the topmost node is operating concern, and under those operating concerns there will be controlling areas. And if the COPA module is not implemented, then controlling area becomes the topmost node without operating concern being designed. Coming to further explanation of the external report. As I have told earlier that external reports follow standard rule, so that those reports are streamlined among different clients, among all companies in a country. Okay, and you have also understood that FI module is the one which deals with external report. So if I talk about the org element in FI module, it is company and then the company code. We have already understood what is company and what is company code terminologies in SAP. Now, next thing is, when we talk of external reports are nothing but those are financial statements. So those financial statements include trial balance sheet and income statement. Since those are external reports, they are prepared as per specific accounting guidelines or accounting standards from a company, from a country. Those accounting standards are nothing but, in SAP terminologies, those are accounting principles. For example, the accounting standards or in accounting principles could be IFRS or Indian Accounting Standard or US GAAP. So now we have understood what are financial statements, on what basis those financial statements are prepared, and what are those accounting rules called in general finance term and in SAP term. We have also seen the examples of accounting principles as IFRS, Indian Accounting Standards, Ind AS or US GAAP. Now, in S4 HANA, we have a provision to prepare parallel books of account. When I say parallel books of account, I mean I can prepare the books of account parallelly as per IFRS, as per Indian Accounting Standards, as per US GAAP. When I say this, I do not mean that we will separately prepare 3 books of account and we will be passing entries into these books of account separately. The provision in SAP for achieving books of account as per multiple accounting principles is called laser approach. So different set of books are represented by different ledgers in SAP. Okay. Now I will be moving with the concept or the assumption that my RAM group of companies is headquartered in India and all of its 5 companies are operating in India itself, but it has a future plan that it will be expanding across the globe in latter point in time. That is the reason I will be required to prepare the financial statements as per IFRS, which is the global accounting standards, and as per Indian accounting standards. Similarly, I will also be required to calculate the taxable income from the Indian income tax perspective. But it is important to note that Indian income tax standard does not require any postings in SAP. it only requires a computation. That is the reason we will not be creating different ledgers for IFRS, IAS and IIT, means Indian income tax. Rather, we will create only two ledgers, one for IFRS and one for Indian accounting standards. When I say this, I mean we will be preparing two set of books, one as per IFRS, another as per Indian accounting standard. Now, if I talk from the accounting principles perspective, so I will link my IFRS to my ledger 0L. 0L is nothing but the leading ledger and it is available by SAP standard. So ledger 0L, which will deal with IFRS accounting principle, this will inherit all the company code assignments. That means whatever assignment the company code will hold, the same assignments will be applicable for ledger 0L. Next ledger that I will be preparing is N1. And this N1 ledger I will be using for local reporting. That is for my Indian accounting standards. So the ledger that is used for local reporting is called non-leading ledger. To the non-leading ledgers, we have to make assignments specifically. That means whatever we assign at the company code level is applicable for the leading ledger. And if we create any non-leading ledger for local reporting, it is must that we make specific assignments as per requirement. Now I hope the concept of accounting principles and ledger is clear. Now, as I have said, I will be assuming that in the RAM group of companies, all the 5 company code are operating in India. So, my ledger 0L is linked to IFRS and ledger N1 is linked to Indian accounting standard. Now, as per IFRS, my reporting year is January to December. And as per Indian accounting standards, the reporting year is April to March. Okay. So the reporting year January to December is codified by K4 and April to March is codified by V3. And K4 and V3 are SAP standard fiscal year variants. So the reporting year is nothing but a fiscal year variant in SAP. Now, let us try to understand how the fiscal year variants are designed in SAP. I am taking 2023 into my example. So I have listed down here January 2023 until December 2023 and January 2024 until March 2024 as months. Now if I follow January to December, okay, if I follow January to December as my reporting year, so January 2023 will be called as period number 1 of 2023 in SAP. Similarly, February will be called as period number 2 of 2023 and so on until December. December will be called as period number 12 of 2023 in SAP. So months in general term is called periods in SAP. Similarly, January 2024 will be called as period number 1 of 2024. So period 1, 2, 3, 4 until 12. This is nothing but a part of posting period variant. Okay. Reporting year is called fiscal year variant and each period of each month of the reporting year is represented by posting period variant. Now let us try to understand if we follow April to March. If we follow April to March, then January 2023 will be called as 10th period of 2022, right? And April 2023 will be called as first period of 2023. So April to March means April becomes period 1 and March 2024 becomes period number 12 of 2023. Now, you might be wondering, we are in 2023 but we are representing the period as 2022. How can this be achieved in SAP? We can achieve this by the functionality of period shift. Okay. So, actually we are in January 2023 but we represent this as 10th period of 2022 by the functionality of period shift. If we put -1 as period shift, that means 2023 will become 2022. And see here, January 2024 is called 10th period of 2023. So here also 2024 is brought down into 2023 by way of period shift -1. So this is the concept of period shift. I hope we have understood what is a fiscal year variant, what is a posting period variant. Now, we have also understood that as per IFRS, I will be following January to December, and as per Indian accounting standard, I will be following April to March. Now, if I follow January to December and April to March as my two different fiscal year variants, then it is must that I have to prepare two posting period variants. Okay. So this is what the concept of posting period variants. I have written a note here that depending upon the number of reporting years, the separate posting period variants are created. Let's say if I have to prepare the financial statements only as per IFRS and my reporting year is January to December, then I will be required to prepare only one posting period variant. That is what it means. Now we will try to understand the different financial statements. So the first one is balance sheet. The balance sheet shows the financial position as on particular date of a company. Okay. Balance sheet shows financial position. When I say financial position, the position of its assets and the position of its liabilities is what is shown by the balance sheet. Now, if we further bifurcate liabilities, we get share capital, we get reserves, some long-term liabilities and provisions, short-term liabilities and provisions, and we can tell us some other liabilities. And here also I have mentioned different classifications within each classification under liabilities. Like under the long-term liabilities and provisions, we can have some long-term secured loans, long-term unsecured loans. Okay. So these specific bifurcations like share capital, retained earning, long-term secured loan, long-term unsecured loan, suppliers, advance to suppliers, short-term secured loan, short-term unsecured loans, these different bifurcations within liabilities, liability headings. These are represented by account groups in SAP. These are represented by account groups in SAP. Now let us try to understand the bifurcations for assets. So under assets also we have different classifications like fixed assets, intangible assets, long-term assets, current assets, and other assets. Under fixed assets again we have different classifications, and also we have different classifications under each of the headings under assets. All those classifications are represented by account group in SAP. This is what we call the balance sheet. Now, I have written a note here. Let us try to understand what this note means. So, you see, under each account group, different accounts are created. Means, let's talk about suppliers. Okay. So, under suppliers, there could be domestic supplier, foreign supplier, supplier for materials, supplier for services, and different other bifurcations. Okay, and each of those bifurcations are represented by the GL account, and those GL accounts must be within the range that is given for supplier account group. So supplier account group will hold a range of number, and whenever any GL account is created, whenever any GL account or any account is created within this group, it has to be within the number range that is specified for supplier account group in this particular example. That is what is written here. Under each account group, different accounts are created and they are represented by unique number. That is the reason each account group has a number range. Now let us try to understand the income statement. Income statement is nothing but the profit and loss statement. So profit and loss statement gives the gross and net surplus or deficit that the company has earned during a particular period. That period could be a month, a quarter, half year, or year. So, since it is income statement, profit and loss statement, it will deal about our income and expenses. If we talk of income, we have some direct incomes, indirect income, and some miscellaneous income we can tell. And again, under each of these headings, there could be different bifurcations. And all those bifurcations are represented by account group, the concept being the same as for liabilities. Similarly, we can have expenses as another classification in the P&L statement. Another expenses we can have different classifications, for example, admin cost, finance cost, production cost, and some other costs. Again, within these costs, we have different classifications. Each of those classifications are represented by account group. Again, there is a note for which the explanation is same that was above. Coming to the next section, wherein we will try to understand what are the sub modules in FI. So, the sub modules in FI are general ledger accounting. In short, it is called GL accounting. We have asset accounting, accounts payable, accounts receivable, cash accounting, bank accounting, taxes. Now, if I talk of last three, cash accounting, bank accounting, and taxes, those are part of GL accounting only, but those are treated separately. That is the reason I have mentioned those as different points here. GL accounting is the one based on which the financial statements are prepared. So the module from which the financial statements are prepared, that is called the main module. Okay, and like asset accounting, AP module, AR module, those are called sub modules. Okay, the information into the GL accounting comes from the sub module and also from the main module itself, from the GL accounting itself. And how about the asset accounting, AP and AR? Those provide the data to the main module, that is the GL accounting, for the preparation of financial statements. Okay, now let us try to understand what are the sub modules in CO module. The sub modules of CO module are cost element accounting, cost center accounting, profit center accounting, internal orders, COPA, product costing. Those are all responsible for internal reporting. As of now, we will just try to understand those sub modules by the names. We will not be discussing in deep, as we will be discussing in detail in the further sessions to come. Now, the next concept is, why do people do business? Business is done for profit motive, to earn income, right? And all the transactions are recorded into business so that we can know our profit. And the formula to calculate profit is sales minus cost. Coming to next concept is, we'll try to understand that there is month closure and year closure for any company for reporting purpose, for monthly reporting and for annually reporting. So as we have understood that there is a concept of sub module and main module in SAP. So this is very generic that whenever we are doing the closing process, we must first close the sub module, because sub module transfers the data into the main module, and then we should close the main module. Now we will try to understand what is the thought process that a good consultant should have. So he must be able to understand accounting from the business point of view. Okay, that is, he must be able to understand business requirements and map those in SAP. Second is, he must think from the consultant point of view. When I say from the consultant point of view, I mean that he must be efficient in requirement gathering. He must be well aware that what requirement can be mapped in SAP and what cannot be. And if a particular requirement cannot be mapped in SAP, what is the alternate way to achieve the requirement? Or whether there needs to be done some customizing to achieve that requirement, if there is no alternate standard methodology to achieve that requirement as well. And third process should be from the user's point of view. When I say from the user's point of view, whatever solution that a consultant provides, that must be user friendly. When I say user friendly, what I mean to say is, the SAP as an ERP should not become a burden for the users. The users should feel SAP as their friends, which has made their work easier compared to any other ERP. Okay. Coming to next concept is the accounting cycle. If I talk of the accounting cycle, then the first thing that happens is the business transaction is happens. When the business transaction happens, then those are recorded in any ERP in the form of journal entries. Then from the journal entries, the ledger statements are prepared. And while recording the journal entries, we must be very sure that only financial transactions are recorded. Non-financial transactions will not be recorded in SAP or in any ERP across the globe. So from the ledger statements, the trial balance is prepared. And finally, the income statement and balance sheet is prepared. And all these financial statements, income statement, balance sheets, those are prepared based on some accounting standards, rules, accounting principles. Coming to next concept is the rules for writing the journal entries. So the rule for writing the journal entries is nothing but the golden rule. If we know those rules, we will be able to write any sort of journal entries based on our basic understanding of the given rules. Let us try to understand those. So in our financial statement, balance sheet and income statement, we have seen that we have 4 parts: liabilities, assets, expenses and incomes. So whenever expenses and assets increases, expenses, assets or losses, when they increase, they are debited. They are debited. Coming to the other side, whenever income, gains and liabilities increase, they are credited. Let us try to read through the statement again. Whenever income, gains and liabilities increase, then those are credited. And whenever expenses, losses, assets increase, then those are debited. And opposite happens in case of decrease. So expenses, losses, income, gains, those are part of income statement, that is the P&L statement. Assets and liabilities are part of balance sheet, that we have already understood. Now let us try to understand different types of journal entries in SAP. So there are standard entries, there are parked entries, there are held entries, there are noted entries and special entries. Now let us try to understand which of those entries will impact my financial statement. So number 1 and number 5, that is standard entries and special entries, will impact my financial statements. Rest, parked, held and noted entries will not impact my financial statement. Coming to another point is, in the standard entries, the debit must be equal to credit. Okay. Also in the special entries, the debit must equal to the credit. In the parked entry as well, the debit must equal to the credit. But in held and noted entries, especially for the noted entries, it is the rule that debit equal to credit does not apply. Noted entries will have only debit or only credit. Coming to held entries can or cannot be complete. Okay. So the basic thing that we have to understand from different sort of entries in SAP is that the standard entries and special entries will impact financial statements and rest 3 do not impact the financial statements. Special entries could be advances, and other than advances and special entries, all entries will be standard entries if those are posted. When I say those are posted, until those are posted, they are in the form of parked entries or held entries, or parked or held. We will try to understand the actual scenarios where we will understand why do we use each of those different sort of journal entries in our sessions to come. So we will be stopping our session here for today, as I think we have covered a lot more for a single session. Meanwhile, I will be closing this session for today, and you all please revise whatever we have done today, so that when I take the next session in continuation of today's session, there is no break and you understand the flow. Okay, let me close the session for today.